This is Taking Stock on Bloomberg. I'm Pimm Fox. My guest now, Jeff Peskind, founder of Phoenix Investment Adviser and the Chief Investment Officer of JLP Credit Opportunities Fund. He's also the former head of distressed trading and a co-manager of the distressed trading business at Bank of America. Now, his hedge fund ranked #1 in distressed bonds in the first quarter of the year. It's up over 200% since the same period last year. Jeff Peskind, welcome to Bloomberg.
Thank you very much.
Talk a little bit about what's happening in the world of high yield credit right now. Spreads have really collapsed.
Yes. Well, the last 2 years have been the most volatile period in history in terms of credit spreads. Spreads in 2007 were at one of the all-time tights, and then during the fourth quarter of 2008 widened out to the all-time wide, where the average high-yield bond was about 2,300 basis points more than Treasuries.
I think the technical term on Wall Street is spreads just blew out.
Blew out dramatically. The bond market collapsed. The credit market collapsed in the fourth quarter of 2008. Since then, there's been a spectacular rebound, and spreads now are back to about 500 to 550 over Treasuries, which is still a little wide from their historical average, but it's been a dramatic rebound.
Why is that rebound happen? Is everybody reaching for yield, or is there some fundamental reasons about the companies that make their credits a lot better?
No, that's a good question. The biggest reason, in our view, is that the Fed has lowered interest rates, obviously in the money market arena, to basically zero. Money has poured out of the money market funds into the high yield funds, and the liquidity in the overall credit market has come back, and therefore spreads have rebounded dramatically. One of the big benefits of spreads tightening has been companies now have access to the capital markets, whether it be equity or debt, and they can refinance their upcoming obligations. So
at a much lower rate, right? I mean, they're able to sort of take all that maturing debt that may be a higher coupon and say, we want to pay a lot less for it.
Exactly. I mean, as a matter of fact, over the past 6 months or so, it's been the biggest issuance in junk bonds in the junk bond market history. So the markets are wide open for these companies to refinance their upcoming maturities.
All right, but is that good for investors? Because I'm always concerned that, you know, when you get a situation where there are a lot of sellers, right, a lot of companies selling high yield debt into the marketplace, that should be a cautionary signal for investors to say, wait a minute, if it's so good for the sellers, maybe it's not so great for the buyers.
No, that's another very good question. Normally, I think that's the case. This time, I think it's different. If you look prior to the credit crisis, what a lot of companies were doing is they were issuing debt and they were leveraging up the balance sheets. This time, if you look at the use of proceeds, what these companies are doing is they're issuing debt and they're paying off upcoming maturities. They're paying off bank debt. They're removing the balance sheet from covenants. So they're actually making their companies healthier, not necessarily more levered. But having said that, I think you're right. The time to have bought a lot of these bonds was back when spreads were very wide. We think today there's still decent value. It's not a great time, but it's not a horrible time to be invested in this at this point.
What about banks? Are banks coming in to finance companies, or is that one of the reasons also why companies are going to the debt markets?
No, banks are back in terms of making new loans. They're not where they were, you know, pre-crisis, but companies have been able to go back to their banks, get new facilities, loosen covenants on existing facilities, and again, that's helped the overall credit environment.
Now, and when you look at the high yield market right now, are there any specific industry groups that you think are still undervalued?
Yes, and that's really what our fund does specifically is we wait for industries or specific companies to fall out of favor, generally get downgraded, or the company misses some earnings guidance and the stock and bonds fall out of favor. Over the last 6 months or so, a big area for us has been the mortgage insurance bonds. Those were really out of favor. Obviously, a year ago, home builders were out of favor. And there's always individual companies that fall out of favor. And just recently, food companies, some retailers are out of favor. Paper companies, newsprint companies, those are out of favor right now. So there's always industries and bonds that have fallen into our niche. Actually, if you look at the market today, and we kind of define our niche as bonds trading below 75 cents on the dollar, there's currently about $40 billion worth of these bonds. Now, the average has been between 10 and 30 billion. So today there's still 40 billion in our niche. So in our niche, we're still finding pretty good opportunities.
All right. Now, in these different industry groups, whether they be the newsprint business or in the food business, are you finding that there is competition coming from non-public money like private equity or indeed even hedge funds willing to invest directly in these companies and therefore taking some of the supply of high yield off the market?
Yes, we have seen that. Actually, what we've seen has been a few private equity firms that own the equity of these companies have been very aggressive about buying these bonds in the open market. Now, that does a number of things for them. Number one, it retires these bonds at a big discount for the underlying companies. It soaks up the supply in the market, which has helped the credit markets rebound. And we're seeing today still a lot of companies tendering for their own bonds in the open market, buying them back in the open market. And again, that helps to the overall health of the credit market.
Right now, what is the biggest thing that worries you? I mean, is there something out there that sends you a caution flag? I mean, what makes you a little bit nervous? When do you get nervous?
No, that's a good question. Again, there really isn't any one thing that makes me nervous about our fund or the overall credit markets right now. Really, we focus on identifying specific companies whose bonds have been, we think, oversold in the marketplace. And it's really just doing more fundamental research on the individual company.
All right, we're going to have to leave it there, but I want to thank you very much, Jeff Peskind, coming to us from the JLP Opportunities Fund. Appreciate your insight into the world of high yield.
Great, thank you.
Thank you.